CNBC says that the housing boom is officially over because new home sales have been falling. But before we jump to a conclusion, let's really dissect what's going on, which is what we'll be talking about in today's video. What's up everybody, I am Jaspreet Singh from theminorityMindset.com, where money minds rethink rich. The housing market has been through a very weird decade. About 10 years ago in the early 2010s, that's when the housing market was really just still recovering from the 2008 crash. When we came into the mid 2010s, so around 2015, that's when the housing market really started to recover and it was really starting to boom. Then coming closer to 2020, coming into 2019, that's when the housing market and the whole economy started to slow down, and that's when the Federal Reserve Bank came out in 2019 and they started cutting interest rates, making it cheaper for you to go out and borrow money. So in 2019, before we were in a recession, we saw interest rates get cut not once, not twice, but 3 times in 2019. This made it cheaper for you to go out and get a mortgage, and this encouraged more people to go out and buy a home. Then came the 2020 pandemic, and as soon as that hit, the entire real estate market froze. People stopped selling homes and people stopped buying homes. Nobody wanted to sell their homes because no one wanted people who were potentially sick walking through the properties, and nobody wanted to go out and buy a home because our whole economic future was so uncertain. But then as people started to understand what was going on with this virus and the pandemic, people started coming out of their homes, and they saw that now in 2020, people saw that interest rates were cut to new historic lows. So now you could go out and get a mortgage at record low rates. So people started going out and taking advantage of these mortgages to go out and buy a brand new home. Then towards the end of 2020, all the people that were thinking about buying a home earlier that year came back out and they started buying homes because now they realized, hey, mortgage rates keep falling. I can go out and buy a $500,000 home and only pay 3% a year on my mortgage, and this is a 3% a year fixed rate mortgage. So now people were taking advantage of these low interest rates, and now you had a huge demand of people wanting to buy homes, and now home prices started to go up. Then in 2021, people really started to realize that this pandemic changed the way that we do work, because people want the ability to now work from home. And if you're going to be working from home, you might as well have a nicer home. You might as well have a home with an office in it, and you might as well have a home with another bedroom because you're going to be spending so much more time there. So now people started looking for homes where they can live and work in, and people wanted to move out of the cities. So then in 2021, you saw a new demand for people wanting to buy homes because interest rates were still super cheap, and now people wanted a home where they can work and live. At the same time, mortgage rates stayed historically low, and you had a very low inventory of homes available for sale because it was taking longer for companies to build new homes, and still a lot of people were not selling homes, and you still had the mortgage forbearance program and the eviction moratorium, which was slowing down how many people were selling homes, and it was also slowing down foreclosures. So you had a limited inventory of homes available for sale, and you had a lot of people that wanted to buy homes, and you had very low interest rates, which made it very attractive for people to go out and buy a home. The advantage of having a 30-year fixed rate mortgage is no matter what happens in the economy, no matter what happens to interest rates, no matter what happens to housing prices, your mortgage payment is not going to change. So as long as you can afford your housing payment, it doesn't matter what's going on in the world because you have a fixed rate mortgage. This is different than what happened in 2008, because before the 2008 crash, everybody had a variable interest rate mortgage, which meant that as interest rates went up, so did your mortgage payments. And so now you had everybody going out to buy a home back in 2008 with a variable interest mortgage, and during the first 2 years, you had a teaser rate, which meant you could get a mortgage, and in the first 2 years, you might only be paying $500 a month. And then when your new interest rate kicks in, well, now you went from paying $500 a month to $1,800 a month almost overnight. All these factors came together to create a very different housing market today than what we saw 10 years ago. 10 years ago, we were in an extreme buyer's market where you could go in and buy a home for literally pennies on the dollar. Now we are in the exact opposite. We are in an extreme seller's market where right now buyers are willing to pay way more than asking price to buy a home because you have so many people that want to buy a home and not that much inventory of homes available for sale. But now it looks like this housing market might be slowing down. CNBC put out an article titled that the housing boom is over as new home sales fall to a pandemic era low. We went from seeing new home sales break record highs to now new home sales going back to what we saw during the beginning of the pandemic. So let's talk about what's going on. But before I do that, I need you to do me a quick favor and smash the thumbs up button below. And if you haven't already, be sure to join our free Discord server called the Guac Talk Community, because as you all know, extra guac is truly a symbol of extra wealth. And in this community, you could chat with other minority mindset thinkers about the real estate market, the stock market, the cryptocurrency market, and all things building wealth. This community is completely free. So if you want to join our brand brand new free Discord server to chat with and network with other minority mindset thinkers. I'll put the link to how you can do that in the description below. Here's what CNBC is saying. Month over month, we've been seeing the housing market boom, boom, and boom even more. What we've been seeing is that new home sales have been growing by about 20% month over month on an annualized basis. But now in July of 2021, we saw it grow not by 20%, but all the way down to just 6%. Now, month over month, that's still a very high growth, but compared to the growth that we've been seeing, it's a lot smaller. This is why a lot of people are starting to theorize that a housing market might be finally cooling down. Business Insider says that the housing market is starting to get better after a historic affordability crisis because home prices have gone up so much, and Market Watch says that the housing market, quote, is no longer heating up according to a new report. The reason why it looks like the housing market is cooling down a little bit is because of two things. First is because of home prices, and the second is more inventory of homes available for sale. Home prices have been going up at record-breaking rates. And you don't gotta be a random guy on YouTube to know that if home prices are going up this fast, but wages are only going up this fast, that eventually you're gonna hit a point where people can no longer afford new homes because their wages aren't growing as fast as home prices are. This is the issue that we're seeing right now with home prices. So many people feel like they're being priced out of the market. This is what the Business Insider article talked about. People feel like they cannot afford homes anymore because home prices keep going up so fast, and now they go look at the price of homes and they get sticker shock. How much money you want for that home? $400,000. Unless you can find a deal, it's becoming harder for people to find a home that they can afford because now they're having to look even harder to find a home that fits their budget. The second thing is the higher inventory of homes available for sale. So this is good news for home buyers because now you're starting to see more sellers enter the market. More and more people are starting to list their homes available for sale, and more homes are finishing construction, which means now if you go shopping for a home, you got more options, which is something you want to see if you're a home buyer. The Business Insider article really dove into this, but these higher home prices affect the demand side of the housing market because when you have such high home prices, you have less people that want to buy a home, and the higher inventory affects the supply side of the housing market because now you have higher supply. Higher supply, less demand, which can help slow down the housing market. Now, this is what we're seeing happen. We've been seeing the inventory of homes available for sale grow month over month, while people have been turning away from the housing market because they just can't afford to go out and buy a home right now. Both of these coming together have slowed down the housing market from the record-breaking months that we've been seeing. Now, I'm not saying this to tell you the housing prices are about to come down tomorrow. What this means is the housing prices are growing not as fast as they were before. A housing market slow down or cool down is great news for people who want to be home buyers because that means you have a better opportunity to find a home that you love and that you can afford, but it's not so good news for the government and for banks. The United States is not technically on paper in a recession anymore, but our economy is still hurting. And one of the biggest drivers of our economic success right now is the real estate market. When the real estate industry is booming, it's great news for the government because it looks like the economy is booming. When the real estate market is hot, that means real estate agents are making money, that means banks and mortgage lenders are making money, it means that title companies are making money, it means that the construction industry is making money, and that means companies like Home Depot and Lowe's are making money because people are going to be going to these stores to buy things to renovate their homes. But if the real estate market's slowing down, that means all of these industries are slowing down, which is not good news for the economy, which is not good news for the government. That's why the government has been working with the Federal Reserve Bank, and the Federal Reserve Bank has been working with big banks to keep mortgage rates at historic lows. In the early part of 2021, we started to see mortgage rates rise pretty quickly, but then when they saw that people stopped going out and getting mortgages, they turned that around very fast and mortgage rates fell back down to below 3% again. And now, still today at the time we're recording this video, mortgage rates are still near historic lows, which is great news if you own a home because now you can go out and refinance on your mortgage, assuming you do it smartly, and now you can pay less money on your mortgage because you can borrow money cheaper. And if you're going out to buy a home, assuming you find a home that you can afford, you can borrow money at very cheap rates, which allow you to go out and buy a home and lock in your mortgage rates for 30 years. The reason why these fixed rate mortgage rates are so interesting right now is because if you go out and you get a mortgage, and let's say your mortgage payments are $1,500 a month, and this is at a 3.5% interest payment. Well, in 2021, the annual inflation is right around 5.4% a year inflation, which means the value of money is going to be dropping. And so what inflation tells us is how much buying power our dollars are losing. So let's just assume that over the next 30 years, inflation is just half of this. And so that assumes that we're going to stop our money printing and we're going to slow down our government deficit. If that happens, that means in 30 years, your $1,500 that you're paying a month isn't gonna feel like the $1,500 you're paying today, because $1,500 a month is more today than it will be in 30 years. In 30 years, your $1,500 a month is really only gonna have a real value of half of that amount because we're seeing such high inflation rates. That being said, if you are in the market for getting a mortgage or refinancing a mortgage, I want you to borrow money smartly because I don't want you to be over leveraged and be left in a position where now you're underwater on your home. Plus, when you're looking for a lender, make sure you shop around because some lenders are going to charge you a whole lot more money and a whole lot more fees than other lenders. So shop around, that way you can keep the most money in your pocket. And one of the easiest ways to do that nowadays is just to use an internet mortgage comparison tool, because now you don't have to call every single lender. You can just use a mortgage comparison tool and they will shop around for you. And the following is an advertisement from our sponsor Credible, who operates a mortgage comparison website. At Credible, you can check pre-qualified mortgage and refinance rates at no charge to you. They have multiple lenders competing on their marketplace, so you can compare great rates and pick the option that's best for you. The process is simple. All you have to do is go onto Credible's website and enter in a few pieces of information, which just takes a few minutes, and Credible will present you with actual pre-qualified rates from different lenders. That way you can compare. Credible's pre-qualification process is easy to use. It only takes a few minutes, and checking pre-qualified rates does not affect your credit score. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I got the link to how you can do that with Credible in the description below. Credible does pay minority mindset and advertising fee when you submit a pre-qualification request, and Credible Operations Inc. NMLS number 1681276 is not available in all states. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I got the link to how you can do that in the description below. When people hear the words the housing market is cooling, here's what they think. So up until now, we've kind of seen the housing market go like this. Here's where we are now. And now when people hear that the housing market is cooling, they assume that this means that the housing market is going to go like that. But that's not what the housing market cooling means. What the housing market cooling means is that instead of the housing market going like this, we might see the housing market go like this, or like this, or like this. See, that still means that the housing market will continue to grow at its current rates because we still have way more demand than we do supply. And as long as we have more demand than we do supply, the housing market will continue to go up. Now, what we're seeing happen is that we're seeing more supply, less demand, which means that the housing market isn't going up as fast as it was. The reason why we're seeing less demand is because people can't afford the homes anymore, and the reason why we're seeing more supply is because more and more people are starting to sell their homes. Well, as long as we see more demand than supply, we're going to continue seeing the housing market to go up. At what rate? Well, this is going to depend on how many buyers and how many sellers there are. But if we start to see more supply than there is demand, that's when we could start to see the housing market start to slow down even more, or maybe even potentially come down to create a correction in housing prices. Again, we don't have the same factors today that we saw back in 2008. Back in 2008, we had the variable interest rate mortgages with the teaser intro rates, which meant people could go out and buy homes and they didn't really know what the real cost of their home was because they were on a very low teaser rate, and a couple years after buying the home, that's when the mortgage payment spiked. Back in 2008, we also had a lot of ninja loans. Ninja loans were an acronym which stood for no income, no job, no asset loans. So you could walk into the bank and say, hey bank, I want to buy this $400,000 home, except I don't have a job and I don't have any investments. I just want to buy the home. And the bank would say, sure, no worries. Here's your money to go out and buy your home. If you want to go out and buy a home today, it's not easy. Banks are going to qualify you. They're going to want to see how much money you're making. They're going to want to see your pay stub. They're going to want to see what assets you have. So banks are qualifying buyers, and people are going out and mainly buying homes with 30-year fixed rate mortgages. Now, this doesn't mean that we're not going to see a housing price correction. I mean, if home prices keep growing way faster than wages, then sure, eventually you're probably going to see a home price correction, because if interest rates go up, which they will eventually go up according to the Federal Reserve Bank, I don't know when that's going to be, but they keep saying that it will go up probably something around 2022 or 2023. But when interest rates go up, now if it's more expensive for you to go out and get a mortgage and housing prices are way up here, people are not going to be able to buy homes. So now you're going to have less demand because people are not going to want to buy a home. And if the supply of homes keeps keep going up, well, now you're going to see a shift in the supply and demand curve, because then you'll see more supply and less demand. When that happens, you can see housing prices start to correct until we see market equilibrium happen again. How big is that correction going to be? Well, there's no way for me to predict that. I have no idea how big the next housing price correction will be, and I also don't know when it's going to be. It's impossible for me to try to time the market. All I want you to do is understand what's going on. The last thing that I want you to pay attention to when it comes to the housing market are government regulations, because we are not in a normal economy. A normal economy is when businesses are running without free government money. It's when people are going out and spending based off of money they're earning from the job, not money from the government. And so right now we are still in a very strange economy where you still have a lot of people that are relying on the government to pay them, whether it's people and businesses. People are still relying on the government, but this money is starting to wane away. As we see the mortgage forbearance program come to an end, and as we start to see the unemployment money go away from the government, then we're going to really start to see how strong our economy is. A lot of people have been holding their breaths, wondering what's going to happen as soon as the mortgage forbearance program ends. Are we going to see a brand new wave of foreclosures? Or are people going to suddenly be able to pay their mortgages again? This is something that we're going to see towards the end of 2021 and into 2022. These are factors that are really hard to calculate because these are not normal things that we see in a normal housing market. But if we start to see a huge wave in foreclosures, that can shift the entire housing market, because that would bring in a whole new wave of inventory of homes available for sale, which could shift the supply and demand curve. Up until now, the supply and demand curve had been kind of shifted on the opposite way, because everybody wanted to buy a home, but people were in forbearance, so they had no incentive to sell their home. And if you were in mortgage forbearance, you also couldn't be foreclosed on. So you had a whole inventory of homes that were locked up, and now this could be shifting. And you also have people that have been paying their mortgages through the help of the unemployment money that they've been getting from the government. And so if that money goes away, or when that money goes away, if those people don't have a means to pay their mortgages anymore, well, that could also bring in new potential foreclosures. This is why you have so many real estate experts confused about what's going on, because you can't just look at the housing market by itself. You have to look at the entire economy, and you have to look at all the government programs out there, because these are things you don't normally see in a normal housing market. But these are the things that we're seeing right now. And as we start to lose this free government money and this government support system, that's when we're really going to understand how strong our economy is. And based off of that, we will really know how strong our housing market is. And these are things we're really going to discover over the next 6 to 12 months. Thank you for watching. If you enjoyed this video, here's the video on things you need to know before you go out and buy a home. And while you're at it, download our free guide on how to start generating passive income. And as always, keep hustling. So nowadays, banks typically like to see a debt to income ratio of less than 36%. So they want to see that your debt is less than 36% of your income. And out of this 36%, they typically don't want to see more than 28% for your mortgage.